Shares of Costco hit an all-time high on Friday, so heading into the long weekend, this is a company that's never been more valuable at $359 billion market cap. It sounds a little bit crazy, but all-time highs can actually be very bullish for companies because it indicates that the business is doing extremely well. So is that the case with Costco? Is this a good time to buy the stock? That's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, let's look at the stock chart because this is a stock that has just been marching higher for decades. You can see here that we do have this all-time high, 816.87, pulled off that a little bit throughout trading on Friday. But overall, the stock has done extremely well. Year to date, shares are up 24.5%. And if you look at this max chart, so this goes back to 1984, 40 years of performance, the stock was trading for $4 per share. So a 200x return from there. Just phenomenal performance for Costco. And what has driven this performance? That's what I really want to dig into because the numbers tell the story and there's a couple of things going on. I'm going to go through a couple of different things here. The first is the company's performance, and then I'm going to talk about the stock a little bit. So from a company performance perspective, it's hard to argue with how well Costco is doing. You can see that over the past decade, revenue has grown at a compound annual growth rate of 8.7%. Keep that number in mind because 8.7%, solid growth rate for a retailer, but not the highest growth rate. So you want to think about what is an appropriate multiple to be paying for a company like this. Let's look at net income and cash flow next. You can see that both of these doing extremely well, both growing a little bit more quickly than revenue. That's because of the operating leverage that Costco has in the business. Compound annual growth rate for net income, 13.4%, and free cash flow, 12.7%. But I do want to highlight what's really driving Costco's results. Because the real differentiator for Costco is that they have a very different business model than most retailers. They don't need to make a relatively high margin of 20 to 30% on each item that they sell to make up for the fixed costs that go into running the business. They make all of their profit on memberships. And then the business itself is basically run at break even. So that gives you an incentive to actually lower your prices to a point where you're moving more volume through the system. The more volume you move through the system, the more you can lower prices because your fixed costs, your operating costs, are spread across more sales. And this is the flywheel that has really made Costco a phenomenally run company. But it starts with those memberships. Now this chart shows in blue membership fee revenue and in orange net income overall. Free cash flow is going to basically mimic net income. So those are kind of two proxies that I'm using. But you can see here that a decade ago, member fee revenue was actually a little bit higher than net income. Basically, those membership fees subsidized running the business at a slight loss, very, very small loss, but at a slight loss. Over the past 10 years, what has happened? Well, those membership fee revenue numbers have increased, compound annual growth rate there, 7.3%. So about staying in line with revenue growth. But the other thing is that net income has grown more than that. That is because operating margins have gone up just a little bit. Costco is squeezing a little bit more out of the operating business. Now, instead of running those stores at a very, very slight loss, they're running them at a very, very slight profit. Still very difficult for other retailers to compete with from a price perspective and from a business model perspective. But this is what has driven the operating leverage in the business, is that Costco has gone from 100%, more than 100% of net income coming from membership fees to now making money on the core operating business. The question is, how much more can you squeeze out of that? And if you're Costco, this is really the game that you're playing. You want to be able to grow those membership fees, but that actually involves building out more stores. There's a limit to how much you're going to be able to grow the business organically by just simply expanding your footprint. So the only way to grow the business with the existing footprint is actually squeeze more out of those stores. But the more you squeeze out of the stores, the more margin you're taking from each sale, the less you're competing and you're leaning into your differentiation from a lot of your competitors. So kind of a balance there that Costco has to strike. And this is where I think you can have a phenomenal business, a phenomenally profitable business, a very, very sticky business, a business that customers keep coming back to year after year after year, happy to pay those membership fees. And there could be limits to the growth. It could be a phenomenal business and may not be a phenomenal stock depending on the valuation. That's what we need to dig into next. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This first chart shows Costco's price to sales multiple. In 2014, the price to sales multiple was about 0.5. Now it is 1.4. Now, one of the reasons you would have a little bit higher price to sales multiple is that margin expansion that I just talked about. So the fact that you're squeezing more out of the business means that maybe that business gets a little bit higher valuation. But there is a limit to what sort of valuation or premium you should be able to get. And you can see that the compound annual growth rate of the price to sales multiple alone, just the multiple, is 12.2%. So again, there's a limit there to what we should be paying for a stock. And this is where I ultimately have a lot of hesitation about Costco. You can be a phenomenal business and not necessarily a phenomenal stock because of your valuation. Let's look at the price to earnings multiple, get another data point in here. 2014, the price to earnings multiple was 26. If that company that I talked about earlier, growing at the high single digit rate, maybe growing net income and free cash flow in the low teens, was trading for a price to earnings multiple in the mid 20s, that could be a reasonably good buy. But today, that's not what we're paying for the stock. The stock is trading for 53 times earnings. That is just a crazy high multiple for a company that's growing revenue in the single digits. And this is ultimately, I think, the challenge for Costco's stock. Yes, the stock is at an all-time high, but it's also at an all-time high valuation. The multiples have expanded tremendously over the last decade. And at the same time, management has actually leaned into a lot of the levers that they have to increase both revenue growth and earnings growth. That margin expansion that I talked about earlier. So how much more can you pull on those levers? How much more are you going to squeeze out of your stores? I don't know that there's a lot more that Costco can do and maintain the solid business model that they have, maintain those lower prices, maintain that customer loyalty. That's really going to be the challenge. And this really comes down to, with every single investment, you can have a phenomenal business, but not a phenomenal stock. And I think that's where we are with Costco. This is one of these companies that I would love to own long-term and just hold for a very long period of time, but I'm not going to pay a huge premium for the company because at the end of the day, this is just a single-digit revenue growth company. Yes, it's going to be consistently generating free cash flow and net income, but I don't want to pay 53 times earnings. That is just a crazy multiple for the revenue and earnings growth that you're going to get from this stock. You can find a lot of companies out there today that are trading for a much lower price to earnings multiple, that are buying back shares, that are paying dividends, that have very sticky business models, and are just a much better valuation. So that's really what's going to keep me from Costco stock. One of these companies that I have really admired, getting to know their business model much more and understanding what differentiates them from competitors. I don't think there's anything that's going to take anything away from that, but the valuation of the stock is a completely different story. And that's what has just gotten out of control over the last few years. So that's what's going to keep me away from this all-time high. Sometimes all-time highs are great indicators for buys for investors. In this case, I think it's an indicator that the multiples have just gotten way too high for Costco. So that's what's going to keep me out. But what do you think about Costco? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.